everyone. This is a live podcast recording, although you'd be glad to hear the camera's only turned on me. So any comments from any of you could be anonymized. What a day we have chosen to gather here in Dallas. We did try holding it in early January, but I'd have to say, Kevin, this is probably a more exciting day to be discussing markets, maybe not for the right reasons, but certainly we are now going to give you a little bit of a kind of a check-in in terms of what we're seeing in different areas of the market. Delighted to have a group of you here with different perspectives from the public equities world to the private credit world to the real estate world and oil and gas. And I'd love if you can chip in and chime in from time to time as we talk about some of the factors that you're seeing in your markets. Some of you may be feeling a little bit better, more sanguine today than others. And I would say that is definitely something that we'd love to discuss. So I have two screens going because one is recorded for Zoom and one is recorded for you. So one is here for you to see. So what I tend to cycle through in markets every week, and we've been doing this since November, is inflation, interest rates, geopolitics, equity markets, and then other asset classes. So I don't think we're going to get to the other asset class segment today. But what we clearly have seen is clearly the other today will be a discussion of yesterday's tariff news, the impact on markets, how markets are receiving it, and some of the intended and unintended effects of what we're seeing. It's safe to say that I don't think this was well forecast necessarily by all economic commentators. There seems to have been a discounting in of some negotiation, perhaps around the tariffs, and we can show some stats there. But it's also safe to say that markets are taking this severely. And that's been the experience since the news was announced last night. And we'll ask, what does that mean for investment portfolios? What should that mean for thinking about portfolio construction going forward? We've heard that this heralds the end of globalization. This is not the first time we've heard this. Larry Fink, in a letter a few years ago, talked about an era of deglobalization. At that time, it was around supply chains being nearshored. This seems to be a much more severe kind of spanner in the works of our global trade systems, such as they are. But is this the end? That's something that I would question and argue with. We know that for every action, there's an equal and opposite reaction. And certainly in the case of these tariffs, we have to factor in the potential for retaliation, for workarounds. And is that being properly factored into markets? President Trump was asked recently whether he was worried about China building alliances with other trading partners. He said, no, he's not worried. Yeah, I'm not sure that that's the final answer. I think there would probably be some analysis to take place, second or third order, about what this does mean for alliances. We've heard about different China, North Korea, and Russia being in some form of an alliance. So I think it's called a CRINC alliance. What does that mean for geopolitics going forward? So quite a lot of follow-on analysis. And then there may be a little bit of positive news that's just come out of what we've seen, and we'll talk a little bit about that as well. Where were we before this all started? We had a Fed that was pausing. We knew that the Fed was feeling uncertain as the inflation was at the last mile, didn't know if it was there yet. We also knew that they were feeling a little bit more uncertain about economic growth. And it seemed to be that the economic growth uncertainty was now replacing inflation uncertainty. It did look like, even though the US inflation picture was not even, it was well below 3%, 2.6, 2.8, a little bit of surprise on the upside, but generally in the last mile. In Europe, we had some downside surprise. It was actually lower than anticipated. We saw that French inflation was about less than 1% below the forecast. Spanish inflation was below the forecast. So Europe is well set up now to be in a position to comfortably cut rates, which would be for the seventh time. They can be assured that their inflation is in check. Some of this data is out of date now in terms of copper being driven higher, wheat being driven lower, and oil before today was sort of stabilizing. So we had inflation at different measures, but what seemed to be replacing inflation uncertainty was growth uncertainty. And that's what we've seen really explode now in the last few days. The sense that, and I think growth uncertainty is much more severe because growth uncertainty is really what undermines consumer confidence, corporate action, corporate spending. And this is something that we believe is now even more under pressure. We've seen economic growth estimates fall from 2% to 1%, and now it's even falling below 1%. And then the big question now is, will this now be the precursor for a recession? And this is certainly, the recession rhetoric has risen quite a lot in recent hours. And where are we in this whole world of stagflation? because this, for weeks, it seemed like stagflation was reserved for the UK, a country I know very well. It seemed that there was anemic growth there and persistent inflation higher than the European area. And that is the economist's nightmare, the idea of the stagflation. It did seem that this focus on uncertain growth, the stagnating part, was quite concerning for investors in the run-up to this tariff decision. And now we can see that if we look at expectations in terms of where they're changing, inflation being the red line, business investment being the blue line, this is a stark change just in terms of inflation expectations being higher. Much of that probably from tariff-related news, but business investments dropping off so much, that is a concern, because that's what will drive CapEx spending. It'll drive investment in data centers, which we know is looking a little wobbly. It'll drive all kinds of business investment. It may even curtail M&A. So this is quite concerning that business investment is essentially grinding to perhaps not a halt, but certainly slowing down. I'd like to ask maybe here at this point, anyone who's involved in the M&A side, working with businesses, have you perceived this uncertainty really factoring into purchasing decisions, investment decisions?
Construction business, it's not M&A. All I do is big construction lending or investment. A bunch of the deals we're looking at now, they've been sidelined because people are petrified of what the costs are going to be. So you have a $700 million project and suddenly pricing pops out 10%, you've got a major problem. So, and you can't pre-buy everything right now. So it's going to get interesting to see how you hedge that situation.
And the interesting part, there's been a little bit of talk, I've never really caught onto this, about the immigration story leading to cost of labor being higher. I happen to think that that may be offset by some of this lack of investment, that there will be more labor in supply. And if unemployment is the next shoe to drop and the next figure to rise, will the immigration situation actually change the price of labor? In your case, it seems to be the price of cost of goods, the supply.
They're worried about, with the tariffs.
And even if it's nationally sourced, I think that's the issue. If the imports are higher and nationally sourced lumber or whatever can actually go higher. I mean, in the real estate business, would you say the same in terms of construction costs? Ben, are you seeing a similar factor in the real estate construction?
I would think so.
Yeah.
On our end, of course, it does affect it indirectly, but I certainly think it's there for sure.
Yeah.
And in the oil and gas sector, cost of goods is affected for sure. Steel.
So we've a long road ahead, certainly, and where we, in terms of consumer confidence, a massive fall off there. And the chart on the right has been the chart, this 12-year chart that we've been citing. Consumer confidence been at a 12-year low. That's actually short-term consumer confidence. So longer-term consumer confidence, the more headline level, is a little bit closer to where it was in 2022. Remember where we were in terms of markets in 22. But consumer confidence, I think, is a serious factor in terms of corporate, clearly demand, spending. We've seen Lululemon stock we were talking about last week, and that's the higher end consumers' discretionary spending. The higher end consumer has been quite insulated from a lot of this pain. It's been very much felt at the lower end consumer level. So the higher end consumer is starting to feel the pinch already. And we will, I think, in the next set of earnings announcements, we're going to hear a lot of caution, a lot of concern about spending. I thought it was quite interesting that we already heard it in the case of Dollar Store and other lower end retailers, even feeling the pinch there. So is there any positive here? For those in the real estate business, clearly the positive news for rates is, first of all, two things. One is that Scott Bessent is more focused on the 10-year treasury rate, it seems, than any other rate in certainly any short-term rate. That's the one that's the best input. You'd like to see that staying low, staying at a level that encourages investment, encourages borrowing. And I would say there's been a dramatic change in the interest rate expectation in the last few days, even since these tariffs were shown to be literal, that we should have taken them not metaphorically. The 3 or 4 quarter-point rate cuts in 25, that's up from just a few weeks ago, it was 1 or 2. So it does look like expectations are that the Fed will have to step in to stimulate growth if growth starts to fall off. One of my concerns with this suggestion is that in the upside, when rates were rising, we saw very little transmission effect from that into curtailing spending. So the question of how much that transmission effect is now pure or is actually interrupted because we're not borrowing to the same degree, we're not refinancing houses. So I'm not sure that monetary lever will necessarily be as easy to pull strings on going forward. But that might be a positive thing, certainly that the Treasury yield seems to be going into where stock investment would like it to be. Stock market reaction, this is already probably out of date. This came from this morning, that we knew that stocks were under pressure before this tariff news. And we also know that when it comes to the stocks in Europe, there was actually quite a bit of correlation there. We talked before about whether stock markets are all going to move in sync. We have seen the European and emerging market stock markets break away from US stock markets recently, but I would say that the fact that now we're seeing a kind of a coordinated fall in markets, clearly there is a lot of contagion that this tariff news has brought about, but arguably the US is probably most likely to be most severely affected by it, and this is what we're seeing just so far. This is the chart which showed the market reaction just during the day of the discussion, and you can see that it was quite severe, from exactly as you would expect, the safety asset gold jumping up, the S&P falling, the 10-year yield jumping up initially and then falling back a little bit, and the Mexican peso falling. So even though Mexico and Canada were not in the crosshairs as much of these tariffs, we know that this is highly disruptive for global trade, and markets reacted. This was even when the chart came out, before we even had a full chance to digest what exactly it was meaning. Where else is some of the good news? There have been some winners of late. We're seeing a lot of contagion at the moment, but we at Moneta have for a long time built core portfolios that were well spread between value and growth. We didn't target just the Max 7. We had value, we had mid cap, we had small cap. We also had a lot of non-US. This was painful for the last few years to have non-US. We can see that Warren Buffett is the hero of this whole, yet again, in his 90s, is showing himself to have been prescient enough to call the go to cash to be invested in some of the value stocks. And it's the value, it's the old economy stocks. You can see that some of the sellers here at CarMax, for example, will be affected, no doubt, by tariffs. But we can see that it has been value and kind of boring type of, I think there's an expression that says boring is the new sexy, that in terms of it paid well to have a diversified portfolio. Value has had its best quarter since the dot-com bubble. This is the other evidence of value is the bond yields heading for 4%. And defense stocks, of course, not just in Europe, where we saw Rheinmetall being one of the best performing stocks year to date. But we know now that more spending is coming from Europe, more investment, less of a fiscal break. And this is likely to all play into a more optimistic outlook for European equity markets. And if we just look at some of the stocks most badly affected, Apple, clearly anything that imports components in the tech side, quite maybe medium term, long term, these will bode well, these changes, but not today. Shoemakers in Vietnam with a 57% tariff or thereabout, big supplier to anyone basically making sports shoes. They're selling off in high single digits. Cryptocurrency, untouched, you might think, by tariffs, but yet clearly another sign that crypto investments are very high risk and risk on. Automakers haven't sold off as much. The tariffs are taking effect right now, but they clearly have already sold off in expectation of this. And furniture makers, Wayfair, any of these, which we all know now are seriously reliant on imports from China, for example, they're selling off in high single digits. So foreign exposure generally would take a large hit, and certainly this has been something that's persisted since last summer. But what I find very interesting is even the small cap index, it's all hidden by more today. So there's no place to hide essentially with this kind of a sell-off, and that has been quite a brutal day for people to experience. And just when we talk about what the actual tariffs themselves started to look like, we are looking at the highest effective tariff since the turn of the century, the previous century. So this is a very meaningful change in the global trading agenda and landscape. And it really is being driven by a single policy. Yes, there have been tariffs, but I do think that we are now moving onto a new playing field. And I suppose I'd love to ask you now again, any of you, what's your view, keeping politics out of this, in terms of the long-term, the need for this type of positioning? That I've always hearkened to comparative advantage and suggested that the reason toasters and shoes were made outside is because there was comparative advantage to emerging markets perhaps making those. And we don't have a comparative advantage, say in Texas or Ohio, with making kitchen equipment. That naturally markets find an equilibrium, And it's simply not, maybe the t-shirt that costs $2 to make in Vietnam would cost $20 to make here. It'll now cost $3 to make in Vietnam. Is that going to move factories here necessarily? So I'd love to hear if anyone is medium term sanguine or optimistic that this needed to happen, or more skeptical.
I think some of it had to happen, but the problem is, I think the problem is too complex. We didn't get in this problem overnight. We're not going to get over it. We're not going to get out of it overnight, but I agree with you. Comparative trade, you're going to have certain country have more lower wage, but then you've got issues of, we saw with supply chain. Do we want to have more shoring with countries we trust? Do we want to have certain industries like metals and so forth, pharmaceuticals, where we want to protect ourselves from a military or from agriculture? And so, and I haven't read all the different tariffs, but it does seem like we have to be very thoughtful long-term about who we trade with, what we're relying on, what the tariffs are. And then you've got the whole debt issue and deficit. So to me, we've got a big problem, and you can't solve it all at once. I know, well, we're hitting a lot of problems at once, but I think it's going to have to be done in bite-sized pieces. And I think it's going to take a long time if you really want to get where I think we need to go. That's my 2 cents.
Exactly, it will take time. Onshoring is not done overnight. We do not bring industry back to the Appalachians overnight. I think these are real problems we have. And I think we're kind of seeing two narratives right now. There's one narrative, which is, well, this is just a starting point of the negotiation. This is the time to get on the phone. This is the time to be first in line to negotiate. Or, this is just a starting point. I've heard one suggestion that we went to the worst case scenario first, and now we will ratchet back from here, which this commentator said he would prefer than kind of having incremental pain. I personally think that this kind of worst case scenario has really been shock therapy, and I'm not sure there will be an easy recovery from that in the positive sense, although we should not underestimate the desire to get into risk assets and buy on the dip. So that maybe is there. I've heard it described as an economic Armageddon today, as well as a verticalization of the US. Now, I was thinking of horizontalization if we're all crushing asset values, but it's in a horizontal way. But the verticalization, the sense of the US being its own island, it's Brexiting of the US as a form of Brexit, various different, whatever images you think of. I happen to think that it's pretty meaningful, and it is, some of it will be not reversible easily, and there will be a whole new kind of resetting of expectations and relationships. And I don't know whether any of you who do business overseas have seen this, but you mentioned trust. I think in terms of trusting trading partners, that perhaps, I know for the time I spent in Europe, there is an extraordinary amount of time spent discussing Donald Trump policies. So I think that it is becoming quite the centerpiece of all international discussions. So I think it will have a serious impact on our relationships going forward, but we are certainly in uncharted waters when it comes to that. As far as we talked about this, the highest in the century, that's really the same way of saying something else. And then what will the immediate effects be? Well, I showed charts with oil and wheat last week. Chocolate and coffee. If we look at we're not big coffee developers here in the US. We don't manufacturers. We don't make coffee. Most of it's imported. Most of it's imported from countries that are now seeing 35-45% tariffs. So I already happen to think that coffee is quite overpriced. I think we're probably now heading for the $7 latte. Chocolate too. I mean, do they have to take away all of our guilty pleasures? So cocoa prices have been heading north anyway. But if we now add a sort of hefty tariff onto that, again, this is going to be inflationary without a doubt. What is the signal of noise? What are we hearing right now? A lot of noise. Certainly, I've talked about economic Armageddon, economic emergency, misplaced nostalgia. This is opinion from the Financial Times. And there's been a bit of digging into the numbers that showed up on the big kind of whiteboard in the Rose Garden yesterday, that actually some of those figures weren't real tariffs that are in effect elsewhere. That, for example, yes, Europe has a value-added tax, but it's on everything. It's domestic produced international goods. It's not essentially targeting international goods. And that in some cases that there might be a 1% tariff, but it might look like a 39% tariff when other factors are factored in. So there was a suggestion that tariff chart was a little bit misrepresentative. It was also a focus on goods, not services. And that most of these countries have actually, for example, Canada would have, it may have a deficit when it comes to goods, but it would have a surplus in terms of services. And the US is actually a much more proficient, I'd say, exporter of services than it is goods. And we can see that from, say, just the various just calculations. So goods alone may present a picture of unfairness, whereas if we factor in goods and services, it might look a little bit less convincing. I'd love to ask you whether you share my skepticism that we are at the end of globalization. This chart here compares 1990 to 2011 and looks at the world share as a percentage of world GDP. And because it's very small, as you get more blue, that is clearly GDP getting the trade share of GDP increasing. And when it's very dark blue, it's over 200% of GDP is trade. So I think it's safe to say that we are trading a lot more, and we have been trading a lot more in the last quarter century. And this is only 2011. If we were to take this into today, it will be even bluer. And yes, there have been supply chain disruptions that have been onshore during COVID, but I think this train has left the station. I don't see us reversing a globalization trend. If we look at how news cycles and how tastes are contagion across different markets, how ideas take root, look at political ideas, how much, say, far-right ideas have been contagious across political environments, as well as then perhaps a swing to the left. Look at how revolutions take hold. I think it's safe to say that globalization is with us today, and I'm not sure that we will see what deglobalizing would look like. And then I think the last question I'd ask you about the Trump cut. Does anybody think that there is a Trump cut? There's a level at which we will start seeing some reverse backpedaling on this tariff regime because the pain has just become too much? Or do you think the president is prepared to play the long game here?
He's been campaigning for 18 months saying he was going to do this. I don't know about everybody else at this table. This isn't a surprise to me. I mean, the guy, I think he's using it. It's just me speaking, but I think he's putting these in place as a negotiating. He's weaponizing. This is a negotiating tool. And as the American public and business so asleep that they thought everything was just going to remain the way it is. And if you look at administrations going back 20 and 30 years, you have these ups and downs of these awakenings of what's happening. And Trump has, opened up a window of a harsh awakening with these tariffs that I'm not going to get political here, but some of the points about tariffs being put in, I think are well done. And then other parts of it are kind of like maybe a little easier on it, but I think it's being used as a weapon and a negotiating tool. And I for the long term, I think there's bound to be some give and take, but I don't think Trump is the type that's going to pull back, go, we're kidding, we're going to cancel these for another 6 months and see how it works. I don't think that's going to happen. I think the market's going to have to adjust.
Yeah. So we will, on that note, I think we will probably have to bring it to a close, but I think what is safe to say is that there's a few realities that we will have to deal with in that adjustment period. Falling output as some of that, the freeze of expenditure, just that, whether it's just construction delays, we're going to see lower numbers there. There will inevitably be rising unemployment. We've already seen some car companies place kind of a furlough or place a freeze on new plants. Again, we don't know whether that's demand or supply driven, but certainly it's uncertainty driven in terms of perhaps their cost of goods. I think we will see higher inflation in the short term because I think there is not enough band. Certainly not every company can not pass these price rises through. I think they're coming in pretty much with very little notice overnight, essentially. So we will see higher prices. And what we're undoubtedly facing is higher economic stress. I think we've already experienced some degree of uncertainty, and the flooding of the zone was the term we used since the administration came in. This level of stress is going to lead to knee-jerk decisions. It's going to lead to lack of investment on the one hand. It's going to lead to people trying to sell and dump on the other hand. And I think we're going to see a lot more volatility in that respect. It's going to be very uncomfortable. And the lack for us as advisors, what we're trying to do is really keep calm. And we also have to admit we don't know necessarily what the future holds, but we equally we know that our portfolios, by being spread in private credit, real estate, real assets, by being global as well as US focused, We are looking at, we're preparing to have those conversations, again, pulling the lens back, looking at the context, and knowing that in 5 years, I think I saw a statistic today, the S&P is still up 118%. It was up 132% before the latest sort of a fiasco here, but it is still up significantly. So we still believe in growth assets. We just believe we'll have a slightly rockier ride. So that is the end of what I had to say here. And I thank you very much for coming and sharing your ideas.